Good morning. Happy Thursday morning. It's dark whenever I leave, and I'm really having a hard time getting out of the house this morning. Anyway, I hope the attendance helped. So, you need a reward for getting here so early. So before we start, Dave Byrne would like to talk about PAS.
Hello. Just a quick reminder, the mock midterm is posted on WebCT. If you go to the discussion board under the PAS thread, you'll find a topic called mock midterm. It's attached as a Word document. A couple things, we'll be taking up the mock midterm in next week's PAS sessions. So usually we get a big crowd. So I'm trying to book rooms that are different than the rooms we currently are in for those of you that come. So keep an eye out for an announcement on a room change. And all the information about the mock is on WebCT, but just really stress that I need you guys to complete the mock before showing up. It's a fairly long exam, and we're not going to have time to take up everything. So I need you to complete the exam, bring it to the mock take-up session next week on Monday or Wednesday, and we'll take up the most difficult questions. Any questions? Yeah. It'll probably be the same. We're going to take a vote, see what people want to take up. But anybody else? Okay. See you next week.
All right. That's great. Yeah, so go to PAS. That's a great opportunity to work together some problems with some friends, get to meet some people from the class too in a smaller setting. Really important to connect with other students too, all right? And as you know, the more PAS sessions you go to, the higher your grade at the end of the day. So go to PAS, all right? I want to bring up, I know I always do this, but I've made announcements in class, I post announcements on WebCT, and I continually get asked by email the very same questions that are here on the announcements, and probably preaching to the choir here, because you probably have seen this, because you come to class all the time, but for those who don't, or just catching this class and they don't normally come to class for whatever reason, your TAs are having office hours. Okay, I've been asked a few times this week, you know, what about the TAs? And so there we go. They've started office hours this past week. Okay, so Marco held some hours on Tuesday. Kathy Liu will be holding office hours tomorrow morning. The same schedule will repeat next week. Okay, and that's in 830 Dunton Tower. All right, so any questions at all? These are third-year accounting students. Know their stuff, okay, so go see them. I'm also holding extended office hours, all right, so because of the midterm, instead of just having one office hour a week, I'm going to have two, all right, so today I'll be in my office for 2 hours, next week for 2 hours as well. Come ask me questions, okay. What I find is I've been getting students from previous years just stopping by to chat, not having any students from this class talking about the course, all right. I've also posted a fairly lengthy midterm review. You don't have to do all of the questions I'm suggesting, but you know, do as many as you can in order to understand the concepts. Once you understand the concepts, stop for that chapter. It's under the PowerPoint slides link on the main page. Okay, so under midterm exam, you're going to see something there. So let me just take you there. Actually, I'm going to have to do the student view. Cancel. All right, so this is what the view looks like under PowerPoint slides. You'll see the midterm review is posted here, okay? Oh, and it's not making it any bigger, is it? Okay. As well, this is important to know, because I had questions on this in previous years. When it comes to the ratios that we're going to be talking about today, right, and there are a lot of ratios we're going to be talking about today, I'm not expecting you to actually memorize these formulas, okay? So what I've done is I've just put down the formulas on a sheet of paper, okay? And this is what you're going to see on page 9. The last sheet of your midterm will be this page. This is all that I'm going to give you, okay? It's just the formulas. Of course, you notice that they're not labeled, right? Current assets divided by current liabilities. I haven't told you exactly what that is. So, you know, I do expect you to understand the nature of this ratio and what it might be. And I can tell you right now it's the current ratio. All right. Net sales divided by average accounts receivable. That's your accounts receivable turnover ratio. But just so you know, you're not expected to actually memorize this. This is days, average age of your accounts receivable in days. This is your inventory turnover. This is your assets to liabilities, long-term liabilities ratio. So it's there. This is exactly what you're going to see on the midterm. Right? So you're not expected to memorize these. You're expected to know the nature of them. All right, so there we go. I am giving away part of the midterm. All right, right there. And another question, I think I even saw it posted on the discussion board. Is there a midterm for this class? I got asked that one. So if one person is asking that question, I know that there's probably a few others that are wondering, Patty, is there a midterm for this? Yes, the midterm. And I know that a lot of you know about this already, but let me spell it out, because I don't want anybody to miss and say, oh, there was a midterm on Friday, October the 29th? Yes, there was a midterm. Okay, so that's from 7 to 9. The rooms I don't know yet. Okay, I've been told it's Azrieli Theatre and Torrey Building, but I don't have rooms yet. And it will be many rooms. Okay, and it will be for this section as well as for Section T. So if you're watching on television or video on demand, okay, this also pertains to you. If you're a distance CUTV student, so you're registered in Section T, you live far away from campus, you have to apply for your midterm and where you might write it. Okay, so there's all sorts of links. Go to carleton.ca/CUTV. Okay, and there's a link right on there about being a distance CUTV student. Okay, hopefully it's dawned on you before now about writing your midterm off campus. All right, so that's just for people far away watching. All right. All right, and what else can I tell you about the midterm? This is just repeating what's already in the course outline. It's on chapters 1 through 9 inclusive, all right? And I whittled it down to 23 multiple choice questions, and there's 4 longish answers. I can't say that they're really all that long. Anyway, longish answer questions, okay? And again, because I always have an online component, an online quiz component to my course, a lot of people say that they would like to get choices like they do on the online quizzes, but unfortunately I can't do that on the midterm. Okay, so you know, if I'm going to ask you about transactions and their effect on the accounting equation, on the accounts, I'm just going to be leaving blanks here for you to fill in, you know, the account name. Okay, there will be no drop-down menu or list of accounts that might go into there. All right, so you know, you are expected to know what asset accounts might be affected by a particular transaction, whatnot. And I will set up tables like this for your 4 questions. All right, so that'll be there. You just have to fill in the table. Okay. What else can I tell you? Oh yeah, the 23 multiple choice questions. You'll be answering on a Scantron sheet, okay? So I know that about half of you are 2nd, 3rd, and 4th year. You know what that means, okay? For those first-year students who don't know what a Scantron sheet is, it's a bubble sheet, okay? So it's red and white, and you fill in your name and student number and your answers, and you shade in little bubbles with a pencil, okay? So here's the important thing. Bring a pencil, okay? Okay, for your Scantron. If you use ink, then it won't be read by the Scantron reader. Okay. Another thing too, in a class even of 200, which is what this class is, there'll be a number of you who will not fill in your name and student number. Please don't forget to do that on your Scantron sheet. All right. For the 4 questions, you'll be answering directly onto the exam page itself. Okay, there'll be no exam booklet. So there'll be a question, and then you'll be answering below that right on your paper. Okay, and it'll be legal size paper and plenty of room to answer these 4 questions. All right. And you can use pen or pencil there. I don't care. All right. Calculator, I was also asked a little bit about calculators by email this week, because I know that in the course outline it says, you know, all business courses you must use this fancy one here. I'm not going to enforce that. I will enforce my no alpha programmable calculator, no alpha storage or programmable calculator. All right. If I see anything I am remotely suspicious of, I've got these calculators I got on special at Walmart. Okay, they can add, subtract, divide, multiply. All right, they're solar powered, brightly colored. My kids love them. They're pink and blue. I will swap out your calculator for one of my Walmart specials. Okay, so this only pertains really to computer scientists and engineers who've got the big thing with the, you know, you can stick in a USB key in your keyboard and whatever. If I see anything huge and big like that, I know There's Alpha storage. I will swap it out, okay? I've got a nice little stash of my Walmart specials, okay? So basic calculator, yes, fine. And I know there's a Casio and a Sharp that a lot of people seem to have from high school. It doesn't have Alpha storage. That's fine, okay? You don't have to get this one, really. Business students do, all right? Sure. Any questions about the midterm? Great. Okay, I'm sure there'll be questions between now and next Friday. Yes? So the question is, can we go over the See Now quiz? I guess now would be a good time before I get into new material. It's in Teach.com. There we go. Oh yeah, that's another thing too. There is no See Now quiz that opened up last night. Okay, I'm giving you a week off. This is too big. All right, so this is my view of things, view of See Now. So there was a quiz, number 4, which was on Chapter 8. That closed last night at 11:55. The next one doesn't open until next Wednesday, okay, and it's on Chapter 10. All right. Oh, yeah. Famous Ford warranty one. Yeah, I had a lot of email about that one. Okay. So you have to just recreate what's in the warranty payable account. Okay. So what do we know about it? We know product warranty payable. I'll make this a little bit bigger. I realize that's really small. We know what the balance was at the end of '07. We know what the balance is at the end of '08. So let's just see what happened in this account. So we'll start with '07 because that seems to be the starting point. It was all in millions. 4862. And then there was activity in the account, and then we have an ending balance. 3840. Okay. So how is this account changing throughout the year? So from December 31st, '07 to December 31st, '08. Well, we know that it's going to be increased for the warranty expense for the year. Okay, so in '08, they're going to make an entry to record warranty expense. This account will be increased. And that as warranties are being honored, okay, so as people go to their Ford dealership and get work done on their cars, all right, and trucks, the cost of honoring the warranty is going to be subtracted from this account. Okay. And I think we're given a little bit about it. So what do we know about it? Ford sales were whatever in '07, decreased to so much in '08. Assume that, oh, I've made it. Assume that the total paid on warranty claims during 2008 was $3,776,000,000. Okay, so that's this part here, the cost of honoring the warranties. So that's what they mean here. Assume that the total paid on warranty claims, that's the cost of honoring the warranty here, okay, $3,076,000,000. So the question is, illustrate the effects on the accounts and financial statements for the 2008 product warranty expense. Okay, so this is what we have to solve for. Okay, so it's just working through an equation. Right? Go back, fill in the blanks. So $4,862,000,000 plus something minus $3,076,000,000 equals $3,840,000,000. Right? And I do believe that, here we go. This will decrease retained earnings. For the amounts to put in here, it would accept just this number in millions as well as if you added all the zeros. Okay. What do I get? 2054. Does that work? Let me just double check my algebra here. Yes. Okay, so in terms of what to put in here, you could do this, or you could do this. Oh, this has got to have an equal minus. You could put the 3 zeros at the end of it. Okay. No effect here, and product warranty expense. Again, it doesn't matter if you put the 3 zeros in or not. Either one was acceptable for this part of the quiz. The last bit, assuming 3,076,000,000 in warranty claims were paid during 2000, explain the 1,022,000,000 increase in the warranty liability from 2007 to 2008. Well, sales were less. You could put, I'm not marking that section. It doesn't really matter what you put in there. Okay. So it would not be graded, and I didn't grade it, and I didn't add. There wasn't any marks for that. Okay. So let's just check our work. Did I do that right? Uh-oh. Uh-oh. I guess I have to keep it consistent, eh? There we go. I'm going to use billions. Use billions throughout, or millions throughout. Okay. All right. Does that make sense? Just recreate what happened, treat it as a algebraic equation, find out what's missing here. What's the plus? Okay, to make all of that work. Any other questions on the See Now quiz? Enjoy your week off from See Now quizzes, by the way. Yippee! All right. All right. Let's get out of everything. There. Chapter 9. What this chapter marks is the end of financial accounting for this course. Right? So this is typically the last chapter in a regular financial accounting class, but you're doing both financial and managerial, right? So after this, we'll get into managerial accounting, which I think is more fun, okay? So far, it's just all been about rules and recording things and whatnot. This chapter does put together everything you've learned so far, okay, and try to make some sense out of it. We've been focusing so much from chapters 1 through 8 on let's look at the effect of the transaction on the account. Let's record the effect on the financial statements. And that's all wonderful, and we need to do that. But what this chapter does is let's take it one step further, okay? Let's take the information that we've prepared and analyze it. Be critical here of the company, all right? Are they liquid enough? Can they pay their bills, okay? Are they going to stay in business in the long term? Will they be able to pay their long-term liabilities? Are they profitable, okay? Answers a lot of those questions. Are they profitable enough, all right? Is this acceptable for shareholders or potential shareholders? So if you're the user of the financial statements, what exactly are you looking at? What are you trying to make sense out of so that you can make your decisions? Okay, so that what I mean by users, you're a creditor. Okay, you want to know, can this company pay off the invoice that I've just sent them? Okay, financial statement analysis will help you understand that. Okay, or you're maybe a potential shareholder. You're looking at a company and you're saying, should I invest in this company or not? Okay. And I know you don't have a lot of extra money right now, but there might come a time in your life where you're going to have to make some investment decisions. Okay. What should I do with my extra cash that I've got? Okay. And maybe investing in a company is one of those things. You might want to buy bonds of a company. You might want to be a shareholder of a company. Okay. What sort of financial ratios should you look at? Okay. It's only actually part of the decision making. There will be other things you have to take into account, but this is a good start. Ratios, financial statement analysis. Okay. So we're going to look at basic financial statement analytical methods. What does that mean? Vertical analysis and horizontal analysis. Okay. So it's just basic stuff. Okay. How much do things go up by from one year to the next? Or what are assets, particular asset account expressed as a percentage of total assets. That's interesting. Then we're going to take a look at financial statement analysis to assess the solvency of a business. What does that mean? Okay, it's the ability to stay in business in the long term, to be able to pay your creditors, okay, to be able to pay your bondholders, as the bonds come due. And then we're going to assess the profitability of a business. And there are different users to all of these assessments. Okay? Creditors, very interested in the solvency of a business. Bondholders, very interested in the solvency of a business. And shareholders are interested in the profitability. I mean, they're also interested in solvency, don't get me wrong, but That is their main focus. Right? And then we'll just look at the contents of an annual report. Okay, so let's start off with some basic financial statement analysis tools here. And one of them is called horizontal analysis. And typically financial statements are given in comparative mode. Okay, here's last year, here's the year before, right? And we are going to compare, did they go up or down? So this is the actual balance sheet of Loblaws, just the partial balance sheet. Okay. So we've been looking at Loblaws Company. I think we looked at them in the chapter for merchandising. Right? So let's take a closer look and analyze everything there is to know about Loblaws. Okay? So that if we're a potential shareholder or even a creditor of Loblaws, let's assess their financial health. So if I take a look at the most recent audited financial statements of Loblaws, so this is the end of the year 08 to the end of the year 09, cash went up significantly. Okay, so if I'm a creditor, I might be looking at this. Actually, it went up. This is all in millions too. Went up by $465 million. Okay, and that is significant because that's 88% increase. Wow, that's something else. Okay. So they are more liquid. We call just holding cash being liquid. Right? So they are more liquid there. Their short-term investments also went up, okay, from $225 million to $397 million. That again, quite significant, not just in terms of dollars, but in percentage. All right, so doing really well there. So that means they've got a lot of excess cash. If you're a creditor, you're probably doing a little happy dance right now. Yes, they're going to pay me. Okay. Accounts receivable went down, okay, which is not a bad thing. It means they're actually collecting their accounts receivable perhaps on a more timely basis. That's what it could indicate. Okay. So it went down $93 million or 11%. Inventories also went down, okay, which may or may not be a bad thing. Loblaw companies has to be really careful about managing their inventory, not having too much, not having too little. They have too much, they're tying up a lot of cash. They have too little. It means when people go to the store, they're not going to find what they're looking for. Imagine going to Loblaws. They have no milk and no bread and no eggs. Well, they're not going to make the sale that day, right? So it went down. I mean, this just could be better inventory management practices. But it's a fine line. Not too much, not too little, but it's relatively insignificant. It only went down by 3%. Income tax receivable, I don't really want to get into a discussion of that in class, or future income taxes, or what other current assets might be. But at the end of the day, current assets have increased by 10%. Okay, so that's, I'd say, relatively good. If you're a creditor, you're looking for this sort of liquidity. And horizontal analysis here is just telling us a limited story. What we're going to see in the rest of this chapter is current assets, looking at the number, that's one thing. Looking at an increase is one thing. But really, we have to compare that to current liabilities. What is due within 1 year of the balance sheet date? Okay. And so what I've done here, just so I'm absolutely clear, when I took a look at the amount change here, the increase or the decrease, I divided it by the base year, in this case 2008. Okay, so 465 divided by 528. That's where I'm getting the 88%. Okay, so what is here? 172 million as a percentage of 225. I want to know the percent increase from 2008. Okay. All right, I've also done some horizontal analysis here for Loblaw companies on their income statement. Okay. And financial analysts will do this for their shareholders. So if you're investing in stocks, okay, I know my dad does quite a lot, and even people at work invest in stocks. And if you have a brokerage account somewhere, you often get, these inside reports, these research reports, analysis reports of companies. And this is thing one that they do, a horizontal analysis of the income statement. Okay, so they want to know how much did all of the items on the income statement go up or down by, okay, in dollars and in percentage. Okay, so here we've got the net sales of Loblaws went down slightly. Look at that. Was $30,802 million, went down just a little bit to $30,735 million. So, we think that, oh, $67 million difference, wow, to me that's a lot of money, but not for Loblaw companies. So they're only off by 0.2%, right? So not a lot overall, okay? And we know that there was some deflation in the grocery sector, actually, so that might account for that, okay? Cost of merchandise sold, this is rather interesting. So this is the cost of the merchandise that they sold, the cost of the goods sold, as it's often referred to. That also went down, okay, which, if sales are going to go down, you'd expect cost of merchandise sold to also go down. Okay, so it went down by $352 million. Okay, that makes sense. But it's the percentage that it went down by that's kind of telling. It went down by 1.5%. You'd expect net sales and cost of merchandise sold to go up and down in tandem. Okay, it's sort of indicating that their markups have changed here a little bit. Okay, because the cost of the merchandise compared to the selling price eventually that they will sell it at has changed. There's been a change in the mix here. Right? It didn't go down by the same percentage. All right? It went down by 1.5%. So the cost of their merchandise went down by 1.5. Sales went down by 0.2. Shouldn't that be the same? Right. So they're squeezing the margins just their suppliers probably just that little bit more. And what's happened? This is kind of interesting to see. Their gross profit has actually increased. Wow. Right. And not just by 0.2 or 1.5%, but it's increased by 4.1%. Okay, so it's kind of like they've done some leveraging here. Small changes in sales and cost of merchandise sold has made a 4.1% increase in gross profit. Okay, so good for them. Something seems to be happening there. They're managing their inventory probably quite well, turning it over, maybe getting better prices on their merchandise. I don't know what's going on, but their gross profit has actually increased in a time where their sales have decreased. So that to me is quite spectacular. That's a good show for Loblaws. So if we take a look at operating expenses, they've all gone up in dollars as well as in percentage. Okay, and we really need to know the inside story here. Okay, and I can tell you that Loblaw Companies is working on having massive distribution centers. Okay, how do I know this? I went online. Okay, I wanted to know more about what's going on here. And financial analysts, this is their job. They'll actually go knocking on the door of Loblaw companies and they'll be asking them, hey, what happened here? Why did your gross profit go up and why are your operating expenses going up and what's going on here? Operating expenses at the end of the day gone up by 2.3%, operating income, even more. Okay, what's going on? So I got a little research report from TD Newcrest. They're a division of TD Securities. This is kind of interesting. Just to figure out, well, what's going on. The numbers are telling me one thing. I want to know the bigger story. Okay. And so this was done back in May 2010 by some CFAs. They're chartered financial analysts. Okay, and what are they saying? A strong performance, to say the least, as Loblaw blew away expectations in Q1 of 2010. Aside from the higher than expected depreciation and interest expense, the company met or beat us on every other operating line. Another 81 basis point jump in gross margin, in line with our estimate. So they're seeing the same thing. My analysis is at the end of 2009. Their audited financial statements, they came out in January of 2010. They did an analysis at Q1 2010. So they're seeing the same thing. And a tight control on operating costs led to an impressive 15% jump in, and I'm wondering, a lot of you are wondering, what is this? EBITDA. It's earnings before income tax, depreciation, and amortization. So it's somewhat like operating income, somewhat. Right? And how it's outbeating Metro for the first time in 3 years. Okay. What else? I know that they are moving ahead on, new IT project, okay, moves from the IT design phase to the implementation phase throughout the year. Okay, and I know that they're working on warehousing. There was a blurb in here about warehousing. Yeah, the new warehouse and transportation management systems continue to progress as scheduled. 3 new depots were fitted with WMS, while TMS was rolled out in 6 others. So they're looking at cost savings that way. Okay, so that's kind of interesting. So and it's not unlike other big retailers going into these large warehouses. Right? I come from Cornwall. I think I mentioned that to you. And there's a huge warehouse there for Walmart. Okay, and Shoppers Drug Mart is putting one in as well. Right? And they're seeing a lot of economies of scale of having huge warehouses. So is Loblaw companies. Okay, we see that here in the analysis. New facilities were opened. Okay, so and that there were some inefficient ones were closed. The Sudbury Depot, Quebec City, and Boucherville meat facility. Okay, so altogether, taken together, Loblaw appears to be well on the way to achieving its goal of having the best infrastructure in North American retail. Okay, so that's what's going on with them, and that's telling a little bit about why are their operating expenses going up. Okay, so they're investing there in infrastructure. What else do we see? Operating income is up. What an amazing feat for Loblaw. Sales go down by 0.2%. Operating income goes up by 14.5%. Wow. Then interest expense, it looks like, you know, they're borrowing a little bit more. Interest rates also went up. Okay, they've been a general trend. They've been going up slightly year after year the last few years. So, you know, you'd expect that. Okay, income taxes, well, if your operating income is going up, so will your income taxes. And you know, at the end of the day, net income of $656 million compared to $550 million the year before. That's amazing. That's a 19.3% increase. Right? So Loblaw to me is really performing well. We see that in the horizontal analysis. That's only telling me a little bit. Like I said, you're going to have to get a bigger story. Go online, find out what's happening. Okay? Go to also the annual report for Loblaws. Okay? I don't have that with me because my stick isn't working. My memory stick isn't working today, but I did have the annual report of Loblaw companies, and they will discuss in detail all of these line items. Why did they go up? Why did they go down? Okay, it's called Management Discussion and Analysis. All right, so that's horizontal analysis. We're simply looking at everything horizontally, right, line by line, and increase or decrease based on the base year. So we're going to divide everything on divide by the 08 numbers. Vertical analysis, we're going to be looking at everything up and down. So it's another way of looking at the financial statements, trying to get them to tell us a different story. Okay? So what we do here is we take every account and express it as a percentage of something. On the balance sheet, we look at total assets. Okay? So every individual line item, cash is expressed as a percentage of total assets. Okay? Accounts receivable, what is that as a percentage of total assets? On the income statement, we use total sales. In this case, net sales. Just so we can take a look at what's the makeup of everything. How is it changing from one year to the next? Okay, so I did do that here for Loblaw companies yet again. Okay. So I'm going to start with net sales. What is that as a percentage of sales? Obviously 100%. So what I'm doing here is I'm dividing every number by $30,735,000,000. Okay. And cost of merchandise sold, the 23,539, I'm going to divide again by total sales, and that's where I get the 77%. Okay. And I continue to do that, and I see that, okay, the cost of merchandise sold was 77% of sales in 09, was 78% in 08. Okay. So maybe they're getting better prices. I'm not sure what's going on here. Managing their inventory maybe a little bit better. Changing their markups. Looks like they're doing that. Actually increasing their markups. So something has happened. Remember markups, what am I referring to there? What is cost, okay, compared to the selling price. Okay, and we see that here in the income statement. Sales, compare it to cost of merchandise sold. This is what we're doing here. So their markups have actually increased. Okay, what are they making at the end of the day? What's that gross profit margin at the end of the day? It's 23% in 09. It was 22% in 08. Okay, so something it's working for them. Selling and admin, you know, we notice if we take the $5,402,000,000, divide that by total sales, it's 18%. The year before, it's 17%. Okay, and this is really retelling what we saw with the horizontal analysis. Yeah, that's they're obviously increasing expenses. Why are they doing that? Lots of initiatives, lots going on at Loblaws. You know, we sort of expect that. Depreciation, amortization, fairly stable at 2% of sales. Okay. Operating income, we again sort of saw this with the horizontal analysis, but it has increased as a percentage of sales. Operating income has increased from one year to the next. Interest expense, staying roughly the same, 1%. Okay. At the end of the day, net income being 2% of sales, okay, roughly. And I'm rounding here. It actually did increase by a few basis points there, but it's telling another story. So, what else? It's useful, obviously, in assessing relationships and trends. Okay, and that's the one thing I don't know if you've noticed. I've been looking at 2 years. Okay, I'm looking at trends. I wanted to, I could probably take a look. Well, what was 08 compared to 07? And it's also useful, vertical analysis especially, useful for comparing one company with another company or with an industry average. Okay, so, how can I do that? It's something called common size financial statements. Okay, so, this is an extension of vertical analysis. Okay, so remember, I took all of Loblaw's numbers and I expressed everything as a percentage of sales. And that's in this column here. Okay, so, sales, 100%, obviously. Cost of merchandise sold was 76.6. I think I rounded it on the previous slide. 77. Okay. And so all of these numbers just taken from the previous slide that we looked at. Okay. Let's compare that to Walmart, okay? Because we know that they're competitors, right? So if you go into Loblaws, you can, especially their superstores, you're not just buying groceries. You can buy just about anything else, okay? So you can buy some furniture, you can go to the drugstore, you can buy all sorts of things, towels, clothing, right? So they have their own clothing lines going on. And if you walk into Walmart now, it's not just merchandise that you can buy, like towels and clothing and whatnot, but you can also buy groceries, all right? So, they're very similar type of companies. So I'd like to compare Walmart to Loblaws, but Walmart is based in the States, first of all, and it's over 10 times the size of Loblaws. Okay? So it's going to be really hard for me to look at both income statements and make any meaningful comparison. Okay? So what I've done in order to compare Walmart to Loblaws, because they are so much different in size, okay, is I did the vertical analysis for Walmart. Took their most recent income statement and expressed all these amounts, all these accounts, okay, as a percentage of sales, just to see, well, how well does Loblaws compete against Walmart? What's going on here? So I see that the cost of merchandise sold as a percentage of sales, 74.6. Okay, so markup is different at Walmart. It's actually higher than at Loblaws. So that for every dollar of sales that they make, they get 25.4 cents, this is what this is saying, in gross profit. So that's available now to pay for all the other operating expenses. Loblaws only has 23.4. Their margins are smaller. Okay? So their markups are smaller. Operating expenses, just off a little bit, by 0.5%. That's not too significant. So they seem to be operating the same way in terms of selling and admin costs. Operating income, this is where you see that, just a little change here in gross profit. What a difference that's going to make in operating income. So Walmart, although it was only off just a little bit in the gross profit percentage, seems to be amplified once you get down to the operating income line. Okay, so for every dollar of sales, therefore, 5.9 cents of that dollar goes toward operating income. Okay, for Loblaws, they're only left with 3.4. Okay. Has to do with markups. Interest expense, well, it looks like Loblaws has got more debt, right, or maybe different interest rates compared to Walmart. They are comparable. They're not wildly off from each other. Right. Earnings before taxes and other items. Again, this is where we see things are starting to really amplify here for Walmart. 5.4% compared to 2.5%. Bottom line, every dollar of income that Walmart gets, 3.6 cents is profit, whereas only 1.6 cents is profit for Loblaws. Okay, so obviously run a little bit differently, but I can make comparisons now. Okay, I can make conclusions about the markup at Loblaws compared to the markup at Walmart and just their cost structures. All right, so those are two great tools, horizontal analysis and the vertical analysis. All right, now we're going to get into some ratios. Okay, so numbers are great. They're telling us one thing. We've done a lot of work in the last few weeks preparing the numbers, preparing the financial statements, analyzing, how are we going to record inventory? How are we going to record shareholders' equity, et cetera? Done some analysis, vertical and horizontal, that's one thing. This is where we get into ratios now, and it's going to tell us even a bigger story. Okay, so the first set of ratios we're going to look at, they're called solvency and profitability ratios, two broad categories. Okay. Solvency, ability to meet debt obligations as they become due, and that's in the short term and the long term. So who would be interested in solvency? Anybody that is owed money by Loblaw companies. All right, so you're a creditor, you're a bondholder, okay, you're going to be looking at solvency. Can they pay the interest on that loan? Okay, can they pay my invoice after I give it to them and on a timely basis? Profitability, that's another broad category of ratios, the ability to earn income. Shareholders are always fixated on these profitability ratios. Always, always. Okay. And yes, they are interrelated. Okay, if you're not profitable, you're not going to generate enough cash to meet your debt obligations. That's pretty obvious. All right, so solvency analysis, we can just break it down just a bit. A current position analysis. We can look at the accounts receivable and analyze that. Okay, we can analyze the inventory and start looking at more the long-term liabilities here and liabilities to equity. All right, so this is more the long-term type ratios. And if you're a creditor who's owed money in the short term, you'd be interested in this. Okay, your current position analysis. Accounts receivable analysis, are they generating cash in the short term from their accounts receivable? And inventory analysis, are they turning over their inventory, selling it enough to generate some cash here? All right, so let's look at what is a current position analysis. Well, there's a few things we can do here, a few ratios, a few numbers to crunch. Working capital calculation is one of them. So what is working capital? Simply current assets minus current liabilities. Okay. We did see an increase, like I mentioned earlier, in Loblaw's company's current assets from one year to the next. Okay. But it's pretty meaningless just looking at that number in isolation. Comparing it to current liabilities, much more meaningful. Okay. So yes, their current assets went up. Did their current liabilities go up twice as much? Yeah. We need to know that. So this just subtracts one from the other. Okay. And you're going to get a number, by the way, a dollar figure. Current ratio, I think this is more meaningful here. Okay. What we're going to do is take current assets, divide it by current liabilities. Okay. And this will tell us how many times over can they pay their current liabilities. Right. So current assets, those assets that you're going to convert to cash within a year, hopefully, or use them up within a year. Let's divide that by current liabilities. Those are the liabilities that are due within the year. That's going to tell me how well I can afford my current liabilities. Okay. Will I be able to pay that supplier? Will I be able to pay that short-term bank loan? Right? And how many times over can I do that? Right? So you'd think, just by looking at it, you want that number to be at least 1. Okay. Greater than or equal to 1. 1.25, okay? Many times over, probably even better, okay? But not too high. You don't want it at 12 and 15 times. Then you're probably holding a bit too much cash. Quick ratio, this one is very similar to current ratio, except it's a little bit more discerning as to what we're going to put in as the numerator. Okay, so the number on the top. We're only going to pull in the really liquid assets, the ones that we can convert to cash really quickly, like hopefully within a month or two. Right? So we're going to include cash, because obviously that's quite liquid. Temporary investments. Okay, so we've got a GIC, okay, or we might have a mutual fund we can cash at any time. We're going to put that in that numerator calculation, just because it represents some really liquid assets. And then accounts receivable, which we know from our analysis, from our chapter on receivables, you like to collect within 30 days, right? That's ideal. It's a general norm. We're going to divide all of that then by current liabilities. So this gets a little bit more stricter. Okay? So how well can you afford your current liabilities? How well can you pay them off? Let's look at the quick ratio. This doesn't add in inventory, okay, which might take some time to sell and to convert into cash. Not going to put in income tax receivable here. Come on, you'll going to convert that to cash necessarily. So we're being really fussy on the numerator. Very liquid assets. Okay. So do we want this to be 1? Yeah, that would probably be good, but you know, around 85.85, that would be probably ideal. All right, so I did this for Loblaws, okay, because I'm kind of interested in investing in Loblaw companies, actually. So I took a look at their working capital, and like I said, you're just going to get a dollar figure, and it's almost kind of irrelevant. I'm not particularly sold on the usefulness of working capital, except to say that it decreased from 08 to 09. All right, so okay, something's happening with working capital, but we can't just assess that number on its own. It's just fine to say yes, they still have positive working capital. That's great. Where I find it gets more useful is in the calculation of current ratio. How well can they afford those current liabilities? Okay. So went from 12.4 in 2008. That is big. That's a large number, okay, for a current ratio. This is still acceptable. 1.2. You can cover it at least once. Fantastic. 1.2 times, great. Quick ratio, this one doesn't mess around. Okay, we want to know what are the really liquid assets. Can they cover current liabilities? It did go down 5.1 to 0.6. Remember I said 0.85 is pretty good. This isn't bad. We also have to know a little bit more about the company to assess is this great. Okay, so we know that Loblaw's constantly turning over inventory, right? You know that if you go to Loblaw companies today, one of their stores today, that the lettuce that's there hasn't been there for too long. They turn it over, right, rather quickly. It hasn't been there for 2 months, I can tell you. Right? That would not be good. So they're constantly, you know, generating cash from their inventory, and that is not taken into account here. We're not including that. But maybe, you know, we have to temper our analysis of this number by just knowing a little bit more about that industry. Groceries, turnover high. Okay, they're going to be generating a lot of cash from inventory. Okay. So that is current position analysis. Really of importance if you're a short-term creditor. All right. So what do you think? Would you do business with Loblaws, send them an invoice, okay, and say, pay me later, knowing what you know about their current position analysis? Are they good for the money? Are they going to pay you? Yeah, probably. Yeah. The quick ratio, kind of on the low side, but let's, like I say, temper that with our understanding of grocery business. Yeah, that's okay. Current ratio, still fantastic. Okay. Working capital, positive. Yeah, I'd send them an invoice and be assured of payment. You know, as a short-term creditor, certainly. Okay. I might also want to take a look at their accounts receivable. Okay, just to know, are they generating any cash from the collection of their accounts receivable? How well do they manage that? Because that's going to have an impact on their cash. Okay. So one of the things we can do is take a look at accounts receivable turnover. How many times a year do they collect their accounts receivable in its entirety? Okay. So very important for a company to make sure that they do this a lot. Okay. The higher the number here, the more often they're collecting their accounts receivable in its entirety. So accounts receivable turnover, how do we calculate that? We take net sales divided by average accounts receivable. So what we're doing here is we're assuming that all sales are on account. Okay? It might not be, and I can tell you that if you go to Loblaws and say, hey, can I pay those groceries later? They're not going to say yes. All right? They're going to want their cash right away. All right? So this is assuming all sales are on credit. We know that not to be, that's not the case. All right? But it does give us some idea about how they do manage accounts receivable. We can take that number. This is really interesting. So take that number after you've calculated. That's how many times over they've collected their accounts receivable in the year. And we can figure out the days sales and receivable. Okay? So take the number you've calculated from above, all right, and put it into this formula. 365 divided by the accounts receivable turnover. Okay? So the first number, how many times a year they collect their accounts receivable, we can change that into the days sales and receivables, which I find is it's a strange name to mean average collection period. How long does it actually take for them to collect their accounts receivable? Remember, we've seen accounts receivable in a previous chapter. You'd like that to be around 30 days. Okay. Really, you know, you can do that. keep it average of 30 days, knowing that some people are going to pay in 7 days, some people are going to take 40 days. You're probably managing quite well. So I did do this for Loblaw companies. Okay. They collect their accounts receivable in 2009 37 and a half times, quite a lot. Okay. And that is up from the previous year, which was only 35.2 times. I'm always looking at trends. Okay. It's not enough just to look at one number. I want to know, well, what was it like last year? And actually, to take it one step further, I should probably compare this number of Loblaw companies to Walmart's to know, are they, how are they performing against the industry? So their average collection period, or their days sales in receivables, 9.7 days, quite good, all right, compared to previous year 10.4. They're doing quite well at collecting, okay, and that's quite a short collection period. But again, what do we know about groceries? Okay? We know that if we go and buy some groceries at Loblaws, we have to pay right away. They don't extend credit terms to just about anybody. Most likely what I think is happening here is they extend credit terms to some of their independent stores, okay, and that's where their accounts receivable comes from. All right, how well do they manage inventory? Remember I mentioned you don't want to have too much. You'll be tying up some cash. You don't want to have too little. People will not be able to buy anything whenever they come to your store. All right. And it does help with liquidity. The more often you can sell your inventory, the more cash you can generate. Okay, so very important there. I'm going to first calculate something called inventory turnover. How many times over will they sell their entire inventory every year? And then I can figure out how long the average inventory item stays on the shelves. And that's called days sales in inventory. Okay. So cost of goods sold, that's what that means. Or cost of merchandise sold. Okay. It means the same thing, cost of merchandise sold. That's going to go on the top. And I'm going to divide by average inventory. Okay. Well, what does that mean? It means I'm going to take the 2009 balance and I'm going to add the 2008 balance and divide by 2. Okay. You're going to be given a comparative balance sheet, okay, at the end of the day. And you're going to have last year and this year. 2 different columns. Take the 2009 number, the 2008 number, add them up and divide by 2. That's how you get an average. And then I can figure out, once I've got that, substitute that into this formula to figure out how long does that piece of inventory, that item of inventory, stay on the shelves, okay, on average. So I take 365 divided by inventory turnover. So I did do that here for Loblaw companies. Okay, they turned over their inventory 10.9 times. Imagine that. Okay, so the average store, let's make that assumption. The average store has turned over their entire inventory 10.9 times. That's amazing. There's a lot of stuff, especially in those superstores. That is down a little bit. Okay. And so how long did everything stay on the shelf on average? Okay, that's what days sales and inventory is going to tell me. Well, it went from 32 days to 33 and a half days. Not bad. Of course, you don't want this to be your lettuce, okay, because a 33-day-old head of lettuce is not a good thing to have on the shelf. But this reflects an average, right? So, yeah, the fruits and vegetables will probably be much higher than that. Their towels and their clothing, probably a little bit longer, right? Depends on the item. Okay. What else can we look at here in solvency? We're going to look at some other ones that are of more interest here to long-term creditors. Okay, so bondholders, long-term liabilities, right? And it indicates here the ability to borrow additional funds on a long-term basis. So what's one of the things we can look at? It's called the ratio of fixed assets to long-term liabilities. Okay, so long-term assets, long-term liabilities. So I did do this here for Loblaw companies. It's about the same. It hasn't changed significantly from one year to the next. All right. And it's telling me a little bit here about, should they ever sell their fixed assets? Would they be able to cover their long-term liabilities? Yes. Yeah. Long-term creditors might also be interested in the ratio of liabilities to equity. Okay. So imagine you're the bank. Loblaw's companies come to you and say, okay, we'd like to borrow more money from you. Okay, Mr. Bank Manager or Mrs. Bank Manager here. Okay. And you take a look at their financial statements and you see that they've got quite a significant amount of liabilities compared to shareholders' equity, which means who's taken the risk here? Okay, if their liabilities are much higher than their equity, their shareholders' equity, who's actually assuming the risk of this company, their success or their failure? Is it the shareholders or the creditors? The creditors, yeah. So if you're the bank and you're being asked for more money from Loblaws, and they have this extraordinarily high amount of liabilities compared to shareholders' equity, and they want the bank, you the bank, to lend them even more money, that means you're taking even more risk, okay, in the success or the failure of that company. Right? So you want the shareholders to also have a little bit of equity, or some stake, rather, in the company, okay, that they've got something on the line as well. Okay, that it's not just the bank and the bondholders, you know, lending money in the long term and taking that risk, but that the shareholders also have some stake here in the company, and that's what this is telling. Okay. So it's simply total liabilities divided by stockholders' equity. And what's a good number? It's sort of who are you? Okay. If you're the bank, you want this number to be small. Okay. You probably want the shareholders to have as equal stake into the business as the creditors do. Okay. If you're Loblaws, you probably want somebody else to assume the risk, right? You probably want the bank and the creditors to have more of a stake in the business. So hard to evaluate this number, but I can tell you that it did basically stay the same from one year to the next. Liabilities did outnumber equity 1.4 to 1. All right. So, you know, it looks like the creditors are taking more of a risk. It's a ratio, right? So it's one number expressed as a percentage or a rate of another. Right? So, but it's not totally unusual. Okay? It's not out of the realm of possibility. It's actually quite good. All right? So the shareholders do have something at stake. Okay? That's what that is saying. Number of times interest charges earned. Okay? So if you're a bondholder or a long-term creditor, you are interested in this as well. Okay? You want to know, okay, that bond, and we studied bonds not that long ago, but last week. Right? So you had those semi-annual bond interest payments we were looking at. Okay? So let's say you have a bond from Loblaw companies. You want to be sure that they can afford your semi-annual interest payments, right? So imagine that. You bought the bond, you paid $1 million for it, and you're hoping for a great return on your investment, and Loblaws can't even afford the interest, let's say. Okay? That doesn't bode well for you. Okay? That's going to interfere with your rate of return. But one way you can verify that they can actually afford that interest is looking at the number of times interest charges earned. So what is that? We're going to go here to the income statement. We're going to get the income before taxes. That's one number up from the bottom. Okay, that last subtotal up from the bottom. Remember, taxes are generally the last thing that we subtract out. And we're going to add back. That's what we're doing here. We're going to add back interest expense. Okay, so before we take into account taxes, before we take into account interest, how much money did they make? And we're going to divide that by the interest expense. This will tell us how many times over can they afford it, okay, the semi-annual interest payment. So what do you think? How many times would you like to have your company, if you're a bondholder, be able to afford the interest? What's a good number? You want them to be able to afford it one time over? Probably a little bit more than that? Many times over? Okay. So there's probably a range here. If this is 1, that means all of their net income is going to be taken up in paying their interest expense. Probably not a good thing. Okay? You're probably going to want to have, you know, quite a lot more than that. Okay? So many times over. Okay. All right. 1, I think, would be weak. So I'm looking at least 4 or 5 times over, if not higher. Okay? Just to feel a little bit more comfortable with this. Geez. So what do we have here for Loblaws? We're looking at 4.4 times in 2009 and 4 times in 2008. Is that good? Yeah, they can cover it many times. I'm probably happy enough here. It's probably good. If this were 1, I'd be really concerned. If this was an even 1, I'd be shaking in my boots. Oh no, they can't afford my bond interest payment. All right. Okay, so actually let's get back to this. Would you like to be a bondholder for Loblaw companies, knowing what we know about these last few ratios, the number of times interest charges earned What else did we look at? And the ratio of liabilities to stockholders' equity. Okay, knowing what we know. And fixed assets compared to long-term liabilities. Just knowing what we know there about that. So their assets can cover their liabilities, or long-term assets, fixed assets can cover their long-term liabilities at least once. Liabilities to stockholders' equity, again, remember I said it depends who you are here. This is, not bad. It means that the shareholders are taking a stake, are taking some risk here in the company, and that they can afford, there's a lot of custom animation here, they can afford their interest many times. Would you buy a bond, therefore, of Loblaw companies? Yeah, it's not bad. I'm seeing a few people shake their head. That's pretty good. Okay. Actually, there are a lot of companies who are a lot worse. Okay. Every time I teach this chapter, I pick on another company. I've seen companies barely able to afford their interest. I've seen liabilities to shareholders' equity like 5, 6 times. Not good. All right. Okay. Next set of ratios we're going to look at is profitability. Okay. I've said this many times already in this class and in other classes. If you're a shareholder, you are really interested in profitability. Okay? And we're going to be looking at just basically a lot of rates earned. That's what we see here. A percentage return. Okay, that's common here. There is a ratio of net sales to assets. That's interesting. How many times over can our assets generate their value in sales? And earnings per share. Okay, it's like a rate. PE, price earnings, and dividends per share. These are looked at quite a lot by shareholders. Okay, dividend yield especially. All right. So, where am I? Yeah, shareholders are always interested in profitability. So this is the Globe and Mail from Tuesday. Okay, they've got a section called Report on Business. Okay, but there's actually a TV channel too called Report on Business TV, ROB TV. So very similar information there. Where did I see it? Oh no, it was in today's Citizen. Oh, I didn't bring that one in. Oh, it's not what I was. No. There was something in today's Citizen. I brought in the wrong paper. But you see a lot of articles about profitability. Oh, and I didn't bring it in. Filter low, don't forsake bonds. Racing for deflation. No. Nope. Brought in the wrong one. But oftentimes you see coverage of, and I should have brought that. In Canada today in the Citizen, and I should have brought it in. Yesterday they released their quarter's earnings, their net income, okay, for the quarter. And it said, it's much higher than they expected, and Canada is quite profitable, okay, for the quarter compared to last year. And they quoted things like earnings per share. That's always a big one, okay, earnings per share. And so what do you think happened once in Canada disclosed its net income for the quarter? And it was stellar. It was wonderful. And I don't have the newspaper here, but that's what they were saying. What do you think happened to the share price of Encana yesterday after they disclosed wonderful earnings and profitability? Did the share price go up or down? Happened, right? So shareholders focus in a lot on profitability and profitability analysis. Okay. And the big ones, I can tell you, for shareholders, dividend yield, the price earnings, and earnings per share. I mean, these other ones too are also quite good, and we'll see that in the TD analysis here. So what are they? Let's take a look at the first one. Net sales to assets. So how efficiently do they use their assets? What is this telling me? How many times over the assets can generate themselves in sales? Okay, so if I take net sales divided by average total assets, I'm going to subtract long-term investments. It'll tell me how many times over those assets are generating themselves in sales. Okay? So what this means is that their assets are quite useful. In 2009, they generated themselves 2.12 times, okay, in sales. The thing to keep in mind here too, every time you see the word average, take the 2009 figure, add it to the 2008 figure, add them up, divide by 2, okay, to get the average. It's trending about the same one year to the next, okay? something that's to be too concerned about. Rate earned on total assets. So this is a return, right? So what percentage return did those assets generate themselves in net income? And I'm not just going to take net income here on the numerator. I'm actually going to add back interest expense. I don't want to muddy the water with interest expense too much, so I'm going to add that back. Because interest expense, not really a sign of, the true net income. Let's take it out to get more. What we're trying to come up with is the operating income, right? And we'll divide by average total assets. Okay, so last year, this year, add them up, divide by 2. And I see that, that's 6.4% this year, 5.6% the year before. So we can actually evaluate this, just by looking at it. What sort of rates of return do you get on any excess money that you have? You've got some excess money, you put it away into an investment. What sort of rates of return do you get? Okay, so maybe not a lot of you have excess cash. That's the problem. If you did have excess cash, let's put it that way, and you decided to put it away maybe in a savings account because you need it soon and you're really concerned about market volatility. Or maybe you put it in a guaranteed investment certificate. That's another safe place, relatively safe place. Okay. What rate of return would you get? Very low. Yeah. Like 0.5%, 1%, 1.5%. All right. So, but it's safe. Okay, especially guaranteed investment certificates. They're backed up by deposit insurance. Okay. That's great. If you went on to the stock market, what rates of return do you think you might get if you invested in a mutual fund in equities or if you bought shares? 3, 4, 5% maybe? Maybe. Some shares, the prices have actually gone down. You get some negative things going on there. So a 6.4% return on assets. Rate earned on total assets. Is that a good return? Yeah, it's not bad, considering the alternatives that are out there. Okay, and that went up from 5.6 to 6.4. That trend is also good. Okay. So I'm impressed so far with Loblaws. Let's take a look at some others. Rate earned on stockholders' equity. So let's take the net income, and now instead of dividing it by average assets, we'll divide it by average stockholders' equity. So again, you see the word average. It means you're going to take last year plus the year before, the year, whatever, the last 2 years, add them up, divide by 2. That's 10.9%. Wow. 9.7%. Consider your investment alternatives at 1%. The GIC. That's good. All right. So I am interested in that. Rate earned on just the common stockholders' equities. I'm really honing in here on the shareholders' equity section. I'm going to take the preferred shareholders out of the equation. So what does that mean? I'm looking at common stockholders' equity. It means I'm going to subtract out preferred dividends. Okay, so what's the net income, therefore, available to common shareholders? And divide by common stockholders' equity. Well, what is that? That is total shareholders' equity, and I'm just going to subtract out the preferred shares, okay, the preferred share capital. Okay, so all the other accounts belong to common shareholders. Okay. And their rate of return, 10.9%, 9.7. That's fantastic. Earnings per share, again, always cited in the business paper. Every time you hear about an earnings report, and I'm surprised I can't find one in this particular newspaper. But you'll see, okay, net income was so much, and therefore earnings per share was. Okay. And there's nothing in here about that. I'm so surprised. Anyway, the wrong ones. Wrong newspaper I brought in. Anyway, so you'll always see that. And earnings per share should also, it's required disclosure on an income statement. Okay. So companies will say, okay, this was our net income for the quarter or for the year, and the first thing the common shareholder will say was, how much was my share of that net income? So that's what we're going to do here. So net income, we'll subtract out the preferred dividends. So this becomes the net income available to common shareholders. And we'll divide by the number of shares. That's going to be a number here. Number of shares, common shares outstanding. Okay. So what's my piece of the pie? So if you're a Loblaws shareholder, net income for just your share was $2.39. In 09, it was $2.01. In 08, trending is great. Okay, it's increasing. Price-earnings ratio. This is a different one. This is, what does the market think about Loblaws? Okay. How excited and optimistic are they about Loblaws? So we're going to take the market price, okay, of each share of stock, and we're going to divide it by the earnings per share. Okay, so that number on the last page, the last slide that I've just calculated. How bullish, how excited is everybody about Loblaws? So the higher the number, the higher the amount of the excitement there is about Loblaws shares. Okay. So this is sometimes just called PE, by the way, price earnings. So they were priced at $33.88 at the end of 09. Their earnings per share for the year is $2.39. So that's 14 times. Okay, so that's quite a lot of optimism. Okay, people think that there's going to be, a lot going on, continued profitability for Loblaws. Okay, the lower the number, 5 or whatnot, the more there's not as much excitement. They don't think there's a lot of potential for future earnings growth. Right? Some companies trade at 40 times earnings. Okay? That's quite a lot. It means that they think that this company is going to show a lot of expansion, increase in sales, lots of profitability, and they're willing to pay more for it. That's what we're saying. The market price, they're willing to pay that much more for it. Right? How many times over will they pay for earnings per share? Dividends per share, this is going to depend on the company's dividend policy. Okay. This is the dividend policy of Loblaw companies. Okay, so I went to their annual report, I actually found that. And they take into account lots of things, their financial results, available cash flow. Some companies never declare dividends. Okay, never get a return there. They did tell us here too what they expect the dividend payment ratio to be, 20 to 25% of last year's net earnings per share. They're not going to give you the whole net income, but they're going to give you part of it, 20 to 25%. Okay. So last year is 84 cents. Okay, so Loblaws does declare dividends, right? And you can expect a return, a dividend yield, if you own some Loblaw shares. Okay. So you hold one share of Loblaw stock. Okay. What's the percentage return that you're going to get on that just from dividends? Okay. So if I take common shares, dividends per share, and if I divide it by the market price, what's my rate of return here? What's my dividend yield? For Loblaws, 2.5%. Is that good? Remember, go back to your alternatives. You could have invested in a GIC for 1.5%. If you just had that one share of Loblaw Companies stock, you'd get 2.5% just from dividend yield. Remember, the other way to earn money if you're holding shares is share appreciation. So if the price keeps going up for Loblaws, you're making even more than 2.5%. The trick is, let's find all the companies that do this consistently, year after year. Anyway, so what do you think? Will you invest in a share of Loblaw companies, knowing what you know about its profitability ratios? What's your recommendation? Should I invest in Loblaw? Yes, yeah. And that actually was, there's this whole analysis that TD Newcrest did here. I don't know if you can see it. They get to the bottom line right at the top. What's the recommendation for TD? So they had these fancy analysts. Okay, they've taken courses like this one and a few others. They're CFAs, Chartered Financial Analysts. And they came up with a recommendation. And their recommendation, this is back on May the 5th, 2010, was buy. Okay, and that's what they do for a living. They take a look at companies. They analyze all their results. Okay, so I don't know if you can take a look here. But they've got things like return on capital. Okay, they've got dividend yield, dividends per share. They're taking a look at quite a lot of numbers, not just the ones from the lecture today, but quite a lot of numbers. They're also looking at earnings per share. That's down here. Yeah. EPS, that's earnings per share. Looking at all of these numbers year after year. What's the trend? What's the expectation for next year and the year after? And they're talking to the company too. They're getting explanations for why did that go up or down. Okay? And the report itself is it's 3 and a bit pages long. They've talked to the senior management of Loblaw companies to get the inside story. what's their prospects for future growth, future profitability. It's all detailed in the many pages here. Okay, so they don't just take a look at the numbers, although then you see there is a lot of numbers here. Okay, their dividend yield and return on capital and everything else. They're looking at the inside story to explain everything, and then they come up with a recommendation. Should you buy Loblaw companies? And the answer is yes, buy it. Okay, and that's only their opinion. Okay, so my father is quite the active investor. He's retired, and he's got time to take a look at companies that go up and down and all over the place. And I don't, so I'm not an active trader. And he subscribes to a lot of these lists. This is just one particular company's opinion of Loblaws. Okay, so he saw a lot of recommendations this past year that said, yes, buy Loblaws. And some even said, it's a strong buy. Yes, buy it now. Okay? And there was a few dissenting votes there too. He found a few reports that said, no, sell. And a few others that said, hold. Okay? Those are generally the recommendations that are made. Okay, so buy, strong buy, hold, or sell. Okay? And like I said, there is all kinds of opinions out there. This is just this particular person's opinion. Okay, that said, yeah, go ahead and buy. And it's up to you to form your own opinion too. Like some people said, yeah, sure, I'd buy Loblaws. I recommend that you buy it. Okay, but I'm sure maybe some of you are saying, no way, that's not good. I don't think they're going to be lasting too long. When you take a look at the competition, you know, they've got Canadian Tire is getting into groceries too, and they're becoming this huge merchandiser. You know, I was in Canadian Tire last weekend, and I hadn't gone to one in a long time. They've got groceries too. You know, like I went to the one away in the East End in Orleans, huge Canadian Tire, and I was there to get hardware because that's what I would usually buy at Canadian Tire. But somebody had groceries in front of me, and I was like, "What are they doing with groceries?" Anyway, so there are other emerging competitors. You know, it's not just about the numbers. It's about looking at the whole market and what's going on. Yes, Walmart is also a competitor. They seem to be competing well against them, but, you know, what does the future hold? Numbers are only part of it. All right. Now we have time to do a problem from the textbook. So we've got the comparative financial statements of Optical Solutions. Right? So they're giving us a whole lot of information, market price. Here's the retained earnings statement. Income statement, balance sheet, okay, and what I didn't scan into here is what are we required here to do, and that's calculate all the ratios, okay, like the whole lot of them, okay. So from the current position analysis to the inventory ratios, accounts receivable ratios, let's do everything. Yeah, so I think the first requirement was the current position analysis. All right. You can flip through the slides, but I'll just tell you that the first one was working capital. Okay. See if I can just go to it quickly. Okay, so the current position analysis, the first calculation will be working capital. We'll also do current ratio and quick ratio. And I think we're just going to do it, yeah, we'll just do it for the last year because we only have one comparative. Now remember, you're not expected to memorize the formulas because I will be giving you a sheet, you saw it at the beginning of the class, with just a portion here. You're going to see something that says current assets divided by current liabilities. You're just going to be given a sheet with the formulas itself. It's not going to actually identify it as the current ratio. Right? So you're going to have to understand a little bit of what the current ratio might be. So you can just pick it out of the list. Wasn't that weird? There. All right. So I need items from the balance sheet. So I'm just going to flip over to that. The current position analysis, essentially looking at current assets, current liabilities. All we need here are numbers from the balance sheet. And isn't this nice? They've added up current assets for me. Just staring at me. So I'll just put those numbers into my formulas. So current assets are oh, this isn't in millions or anything. So 1,116,000. I'm also going to need current liabilities. It's probably on the next page. There we go. Oh, look at that. It's just one number. Right? Current liabilities, 360. And I don't really particularly like this ratio. Yes, it's given me a number, 756,000. Is this good or not? Well, it's positive. That's good. It's hard to evaluate just by itself. Depends on the size of the company. Depends on the amount of current liabilities. Okay. For the Horticultural Council, this is a lot of working capital because I generally only have about $200,000 in working capital. Is this good enough for this optical company? I don't know. Okay, next is the current ratio. I'm going to need that current asset number again, except this time I'm going to divide by current liabilities. And I think this is more meaningful. How many times over can they pay their current liabilities? 3.1. That's great. That's many times over. That's at least once. So yes, they are, solvent and liquid in the short term. Liquid enough. All right, next is the quick ratio. I'm going to be a bit fussy about what I put here in the numerator. So I'm looking at cash, yeah, that one. Temporary invest. Oh, I heard about that. Did everybody get this notice? They're trying the incident management system. Anyway, acknowledge. Now what? There we go. All right. We've got cash. That's quite liquid. We only want the really liquid assets here. Temporary investments. That's good. Accounts receivable. And that's it. We draw the line right there. Okay. We do not want to add inventories here, prepaid expenses, or income tax receivable, or anything else. Okay, because it's not liquid enough. Looking at those that most likely be converted to cash relatively quickly, in a month or two. Okay. So I've run out of room here on this page. So I'm going to bring it up here. So what do I want in the top? 240. And what else? 260. All right. So I'm taking the cash, accounts receivable, short-term investments. That's my numerator. My denominator stays the same as the current ratio, so current liabilities. There we go. Got 2.4. Wow. Okay, remember I was saying like 0.85? It's pretty good. They've got 2.4. That's quite good. Right. There's also a danger too, having these numbers too high. Okay. So, imagine you're just an average student, imagine that, and you've got $100,000 in your bank account, and you've got absolutely no bills to pay whatsoever. Is that a bit excessive to have in your bank account? Could you do something, a little bit more profitable than just a bank account? Most likely. Okay, so if these numbers are too high, the current ratio or the quick ratio, why would you have so much liquidity? Okay, too much liquidity, not necessarily a good thing. Yes, you can afford to pay tuition, right, in your books, but there's probably a better use to your money. It could also be too, if these numbers are excessively high, it could mean that the company's trying to amass some cash for a big purchase. Okay, so it could be that you've got the $100,000 in your bank account, but you're going to be buying an expensive sports car tomorrow. So you need it, or you're going on that cruise in the Caribbean over the Christmas holidays, and you need it, and you're taking your whole family. All right. Okay, so those are the current ratios, current position analysis. I'd say they're quite in a good shape here to pay their short-term creditors. I wouldn't mind lending them money in the short term. I know they're good for it. Okay. Okay, what else am I going to do? I'm going to take a look at how they manage receivables. And there was two here. Let's see if I can flip through it. Yeah. So there's two ratios we can take a look at. One is the accounts receivable turnover. Again, I'm not going to have you necessarily memorize the formula, but this portion of it will be given. Okay, net sales divided by average accounts receivable. And days sales and receivables. I don't know why the book calls it that. It's average collection period. They also give a slightly different formula, but I think this one's easier. All right. So I need net sales, and I know that's on the income statement. And where is it? There it is. Net sales. 80. And I'm going to divide by average accounts receivable. Wow. There's my accounts receivable, and I need to take an average, right? So I've got last year, I've got this year, add them up and divide by 2. And I don't have space to actually show that calculation, but I can do it on my calculator. So that and that, add them up, divide by 2. $6.8. So they collect their accounts receivable 6.8 times a year. Sounds pretty good. The higher the number, the better. Obviously, it means they're managing their accounts receivable well. You know, that's really important for a company. Recently started this company, started work in the summer, and their accounts receivable balance about 100,000, and they had, forget how much, 40-some thousand of that was accounts receivable that was 90 days or more. A lot of it dates back a number of years. Okay, if you can't manage your accounts receivable, you're going to find yourself short of cash very quickly. So my first thing I was told is, okay, Patty, here's our accounts receivable, here's our balance sheet, and we have no money for payroll next week. Anyway, sleepless nights. So yeah, manage accounts receivable, and you'll have enough cash in the bank to pay for payroll. All right, so we take 365 days, divide by the accounts receivable turnover. What does this tell us? It tells us the average collection period. $53 days. Is that good? It's not bad, eh? Yeah. You hope that everybody pays in 30 days, and that's what your average works out to be. But you know, some industries are just notoriously, you know, bad for collection. Construction industry, hard to collect in 30 days. So, you know, it depends. I don't know about Optical Solutions. I don't know the nature of their company here, but that might just be the norm. Okay, so what else are we going to do? That was the receivables analysis. We're also going to do inventory analysis. Dear. So very similar, you know, to receivables, except we're going to have inventory turnover and average days. Well, what do they call it? Days sales and inventory. Call it average days before it's sold. those are the formulas we need. Let me go there, right? There. All right, so I need cost of goods sold. And that's really easy to find here. What is it? 480,200. And average inventory. Made more room here this time. Average inventory. I do have a line for inventory. Can't even see it. What have I done? There. So it's gone up, eh? So I take last year's, this year's, add them up, divide by 2. 66.4. So 3.5 times. That's how many times over they sell their inventory. Of course, you're going to want to look at trends and industry averages. Is that right for that sort of industry? So, to get exactly how long the average piece of inventory is going to sit on the shelf, take 365 divided by inventory turnover, I get 104 days. Again, it sort of depends on the industry. Grocery store, you want this to be really quick. Don't have old produce on the shelves. All right, so that's inventory analysis. Oh, there's still more. There. We're going to look at some more ratios then for the longer term creditor. One of them is fixed assets to long-term liabilities. And you find that the name of the ratio looks an awful lot like the actual formula, right? So fixed assets to long-term liabilities. Okay, that's what that is. Let's pick up a few more here, a few more formulas. Liabilities to shareholders' equity. Let me pick up a few more. Oh yeah, number of times interest earned. I'm just going to put that on a separate sheet. All right, so I've picked up 3 formulas there. That's more for the longer term creditor. I think that was it, eh? Yeah, and then we get into profitability. Oh, it's not there. So, fixed assets. Net. So, I've got some, I've got this on the wrong thing. Some longer term assets here, but what do I mean by fixed assets? I'm referring to these here, the capital assets. Okay, that's what I mean. Because I want to know, am I using them efficiently? That's really what this formula is getting down to, is am I making good use of the property, the plant, and the equipment, the land, that sort of thing. Really don't care about how well I'm using my long-term investment. But I want to know that I don't have equipment that's idle or not being used in operations or idle for excessive periods of time, not generating sales. So I'm focusing in just on that line there. And it says net, and that just means after accumulated depreciation. I'm going to compare that to my long-term liabilities, and there they are. I've got a mortgage note payable due in 2015 and bonds payable. 1,184,000. 1.3. Okay. So their assets fixed assets cover their long-term liabilities many times. Total liabilities, total shareholders' equity. That's an easy one. Who's taking the risk here? The interpretation of this number depends on who you are. If you're a creditor, you want the shareholders to also have a risk. You want this number to be about one-ish. You know, you want to have equal parts risk and stake in the company. Okay. Any higher than that, you start to feel a little bit uncomfortable. What else do I have here? The next ratio has to do with interest times interest earned. I want to know, how well does this company afford its interest expense? So I'm actually interested in not net income. What I want to do is go up a few from here. Okay, so I want net income. I'm going to add to it interest expense, okay, and income tax expense. So I want both of those there. Okay. And we'll see that it's actually staring at us. It's this amount here. So I could take net income, I could add back taxes, I could add back interest expense, but I see that that number is already on the income statement. 587, 880. And then I'll divide by the interest expense. That would be that number there. 5.3 times. I'm feeling a little bit more confident if I have a bond here with this company that they will be able to afford the interest expense. Okay. Any questions so far in any of the ratios? Okay. All right. I'm going to get into the profitability analysis. Oops. There's quite a lot. Ooh, ooh. So ratio of net sales to assets. You know, that one's often called asset turnover. I don't know why the book doesn't call it that. By the way, the ratios, both the names and the actual formulas change. Different users have different names for them and even different formulas, which I find kind of interesting. Oh, I think there's a plus there. So we'll just go through, pick up all of these formulas here. So net sales divided by average total assets. Got that. Rate earned on total assets. I'm going to take net income, add back interest expense. What else? I'm just going to, like I say, pick up these formulas. And then I'll come back to it. There's another one. So this is just the net income available to common shareholders now. So I'm going to subtract out preferred dividends. All right. So that's a fair number of them there. Okay, so I need net sales first. There it is. $602,080. It is. And I need to divide by average assets. So again, you're going to have 2 years worth. Add them up. Right? Divide by 2. I'm always running out of room for these. 2860 2024. There we go. Hope you can see that. So I'm taking last year, this year. Add them up. Let's divide by 2 to get an average. Wow. Double check that calculation. There we go. Well, 656. Oh. Okay. So the assets are not even generating their own value in sales. Yeah. And again, you're going to have to look at the trend to evaluate that. Look at the industry average. Next one, I want to get net income and add back interest expense. I don't want interest to muddy up my interpretation here. What's my interest expense? 110. And average assets. Oh, I've got that still in my calculator. So you can express this as a percentage too. Like it's 0.22, but you can also put down 22%. Doesn't matter on the midterm. I'll accept both answers. It's the same number. And that's really good. 22% considering investment options. It's really good. Next up, I'm looking at more the rate of return on shareholders' equity. Okay. So I'll start with my net income and divide by average shareholders' equity. What is that? That's going to be that number, that number. Let's add them up. Divide by 2. I'll just round there, 38.6%. Oh, by the way, I will specify on the midterm how many decimal places I want you to round to. Okay. Worry about that. So 38.6, again, quite good. Right. It's interesting, too. We just calculated the rate of return on total assets on the previous page. So we're looking at 22% there. Right. The rate of return on the shareholders' equity is 38.6%. Okay. We call that leveraging. Why is certain parts of the balance sheet returning more than other parts of the balance sheet? So assets, 22%. Shareholders' equity, wow, 38.6%. It's because they've used liabilities. Okay, I'm not going to get into too much detail on that, but it is called leveraging. Okay, so they borrow in order to increase the rate of return on shareholders' equity. Okay. Rate earned on common shareholders' equity, we're going to be just a little bit more specific about the numerator and denominator. It looks very similar to the ratio above, except I'm going to remove the effects of preferred shares and preferred dividends out of there. So, preferred dividends, go back to that statement of retained earnings. I know we haven't taken a look at it in a long time. So, what would be available to the common shareholder? What net income would be available to the common shareholder? Let's subtract out preferred dividends. And we're going to be specific too about the shareholders' equity. We're going to take the common shareholders' equity, which means we're not going to count this line, this whole preferred stock. Okay. We're just going to look at the average of common stock and retained earnings from one year and the next. Oh, and I never have room for this. Okay, so if I add them all up, let's try that. I add all of that up and divide by 2. What do I get? Yeah, so we do count retained earnings into the common shareholders' equity. Okay. What we're doing is just not counting in the preferred stock capital, the capital account. Wow, we got 42%. Great returns. That's really good. All right, let me get into some other ratios that a lot of shareholders pay attention to. Things like earnings per share, price earnings ratio, and dividends per share, dividend yield. So I can leave part of that up there. What else are we going to look at? The price earnings ratio. All right, so let's just go back and look for those formulas. There we go. So I think we've got the net income minus preferred dividends. We just calculated in the last formula. Okay. So if I just go flip back here to the previous sheet, it's 428 minus 4. Okay. The same numerator. Number of shares. How am I going to find that? It's hiding, actually. So normally you'd just be given the number of shares. This problem isn't telling you the number of shares. But I can figure it out. Oh, it's not from this one. Ah, it's sneaky, too. I like how you have to figure out the number of shares. They use par value. This is an American textbook, after all. And common share account here, common stock account's got a balance of $200,000 at $5 par. So what I'm going to do is just divide one by the other to figure out the number of shares. Okay. It's sneaky. Because that's how they actually arrive at that account balance, is they multiply the number of shares that they issue, multiply by the par value in order to get the 200,000. So I know that there are 40,000 shares outstanding. Well, that's 10.6. I'm not reading the decimal. $10.60. That's really high. Wow. All right. It's more just a function of how many shares outstanding you have, right? And it's obviously net income. So price earnings, we are given the share price, $60. We'll divide by EPS. And it's relatively low, 5.6. Okay, so the shareholders and potential shareholders aren't willing to pay that many more times earnings per share to buy it. Okay. And what do we have next? Dividends per share. common dividends divided by the number of common shares. And the last one was dividend yield. I like that one. Imagine that. The banks, the dividend yield for banks are always around 5%. That means you can always earn about 5% just in dividends alone. That is so much higher than my GICs anytime. All right. Oh, it was just on the next slide. So common dividends, what were they? We'll get it off of this schedule, right? Retained earnings, it's 12,000. Number of shares we already calculated is 40. Wow. This is expressed like as a dollar value. Common dividends again. Dividends per share, right? And I think the market value is 60, right? That's what they're saying on that top of the 0.5%. Oh, that's relatively low. Anyway. All right. Any questions about ratios whatsoever? Oh. All right. We've calculated all of them. All right. Annual reports. I think I mentioned this at the beginning of the term even. Yeah. They are generally published. If they're a public company, they're published and usually put on the internet. You can also get these old style printed copies, but nobody ever prints them anymore. And they've got large sections. They're usually divided into large sections. The financial statements and the notes is usually one section. I don't know if you can tell that either. Financial statements are the blue down here, okay? So that much thickness. And the management discussion and analysis, that's this big section, and they've just coded it blue here on the side. And that's explaining almost every line and segmentation and what management thinks is going to happen, how they performed. And then, of course, the independent auditor's report is the other one. And that's giving assurance to the shareholders, just a little bit, about can they rely on these financial statements or not. Okay? And so what happens is if you're a public company, you have to have an audit. That's what the CBCA says, your Canada Business Corporations Act, unless you opt out of it. But if you're a public company, you're never going to opt out of it. And you have a CA firm. In this case, this is Bank of Montreal. They have a firm called KPMG as their auditors. Okay? And they've done an audit, and that's what they say. We've audited the statements. We've conducted our audit in accordance with Canada's GAS, or auditing standards. And then they express an opinion, and that's really the most important part. In our opinion, these consolidated financial statements present fairly in all material respects the financial position of the bank, okay, and the results of operations. They're not saying they're perfect. They're just saying they're not materially misstated. They're not wildly off. Anyway, and that gives you some assurance, okay? You're a shareholder. You're like, okay, I can count on that. Anyway, MDA can be quite lengthy, and it's all about what they think is going to happen. Oh yeah, and risk exposure, that's a new part. You never used to see that. You see that a lot more now. Auditor's report I've got up here. Yeah, and that's the end of chapter 9. Yippee, we're done. All right, well, have a good weekend, and don't stop studying for the midterm. Lots of review questions there. Do the PASS mock over the weekend. That would be great to get that done before you go to the PASS session.